Now that April 15th is passed, taxes are done for the year, right? Au contraire. The biggest mistake that people make is at this time of the year on their taxes, and we're going to tell you what that is and how to fix it on this episode of Friends Talk Financial Planning. Hi, I'm John Shear, and I run a fee-only financial planning practice in Middleton, Wisconsin.
And I'm Bridget Sullivan-Mermel, and I've got a fee-only financial planning practice in Chicago, Illinois. John, before we start about the biggest mistake, please, we'd like to ask you to subscribe. It helps us with the YouTube algorithm and helps the channel. So, John, let's talk biggest mistake.
Yeah, so here, spoiler alert, biggest mistake is not doing tax planning. Right? Planning, not preparation. So there, we can, end of discussion, right? Quick 2-minute video. No, you want some more information on what planning is? Let's talk about that, because I talk with people and they say, oh yeah, I've got my tax guy. Yeah, they do planning. They tell me what to make for estimated payments. I got my plan for the year, right? Not exactly how we do things, right?
That's good. I'm
it's
glad
a start,
you got
right?
estimated
You
payments. That's better than not having estimated payments. However, that's not proactively planning. For me, the metaphor I use is I want to paint my living room, and I go downstairs and just look and see what paint's around and what materials around, and I use that to paint.
That's
okay,
awesome.
if that's my plan, that's what doing your taxes after the fact.
Right.
And not
you can
thinking
do it,
before.
right? You can paint your house. I got enough paints in the basement, or I could paint my house, but I'm not going to be, it's not a real
it's not going to look as good as if I
things.
plan.
Yeah, that's exactly right.
Yeah.
So what we mean, and I think we operate similarly on this, Bridget, is planning is taking a look at, okay, what happened last year? And then what do I think is going to happen this year? Is my earned income going to be the same? Are my investments going to be the same? Are my deductions going to be the same? And look at, okay, if last year is exactly like this year, what does it look like? And then what sort of changes do I expect to make? And then taking a look at, okay, what things could I do about that, right? And that's and looking and going, oh, geez, yeah, but if I do this or if I do that, put more money in my 401k or make more donations to charity, or if my income is variable like yours and mine, or if you run your own business, what does it look like this year if you're a salesperson? Those sorts of things. That's sort of one of our approaches to things, is taking a look at last year versus this year, and then what decisions can we make this year?
Right. To optimize our taxes.
That's right.
So I would say that often with people who are younger and have regular jobs, we're looking to make sure that their 401k contributions are what they think they're going to be. And we also check itemizing and if there's any opportunities there. Because some people itemize some years and some people don't itemize other years.
Right, and itemizing, just to throw the jargon police in there, that's if things like donations to charity, some years you get credit for it, some years it doesn't really do any good for you, and you need to take a look at that each year, right? Those sorts of things.
Right, and another item is when you're older, you have a lot of opportunity, like in the years before you retire, and then transition to retirement, and then other items, benchmarks are when you start taking Social Security and when you have to when you start taking money out of your IRAs.
When you have to.
When you have to, or when you do. Like some people take money before they have to. So those are all benchmark years. And there's a lot of planning you can do around them to make sure you're optimizing things.
So one of the things that I appreciate you saying that, hey, these different benchmarks, and especially as you get older, right? You retire, you take Social Security, you have to take money out of your IRAs. And one of the things we always talk about with folks is when you have changes in income, those are huge opportunities, right? Income goes way up, there's opportunities, or income goes way down. So what are the things we're talking about? We've had folks over the years that have sold businesses, sold big investments in things that have either gone up or down, taken different jobs, or retired. Maybe you got laid off and you're still looking for a job. This is an opportunity, right? It's a bad deal from, geez, I don't have my income that I wanted. It's a good deal because you say, listen, how can we make lemonades from the lemons, right? I get a new job. We had a client that was taking a new job and he was getting a big sign-on bonus to take this job. And so we looked at his taxes. Here's what it was last year. Here's what it's going to look like next year. And this big signing bonus was able, I said, well, listen, if you have to take it all this year, here's what we think it's going to look like. if the company would be willing to say, geez, instead of paying it to me in November, let's pay it to you in January, what that might look like. And it was like an $8,000 or $10,000 savings just because of where, his sales job, and he had big commissions this year and he's starting from the ground, next year, those sorts of things, seemingly innocuous, right? Hey, I got a nice raise. This is going to be a good opportunity. But by being proactive, if we had waited until April, the opportunity's gone, right? Those sorts of things, when you have big changes, and those big changes would be, hey, when I start taking Social Security, when I get to retirement, those types of things, those are the real opportunity. Those are one place where hey, if I'm going to have a change in income, golly, that tax planning it can be golden for you.
Right, and I think another major area is when you get to retire early. Mm-hmm. So when you're retiring early, and you have a lot of tax planning opportunities. So I had one couple that I was working with that they were able to take advantage of the premium tax credit. Okay. So
for their health insurance.
Yeah. And so they were able to take advantage of that. And they had because once you're retired, you have a lot of control over your income that you don't have when you have a W-2. Mm-hmm. When your W-2 rolls in, you just have to pay tax on it. You have no options.
Good news, you get a paycheck every 2 weeks, right?
Yeah.
Bad news is you have flexibility from a tax standpoint.
And there's this idea out there that the rich don't pay any taxes. Well, if the rich get their money on a W-2, they're probably paying a lot in taxes. Okay, that is my experience.
Yep.
There's not really any way around it. So when you get a W-2, you don't have that much flexibility. But when you don't have a W-2 and you're retiring, you have a lot more flexibility. So again, that's when you can take advantage of things like the premium tax credit, and that requires keeping your taxable income looking lower.
That's right.
And so we manage people's cash flow with that in mind. It's very integrated tax planning with their cash flow planning.
Yep.
And so those are people that are retiring early.
I was just going to say, we were talking with a client here recently, and they're planning to retire in like 3 or 4 years, and they talked to a friend and said, geez, they have no income, and they're getting the premium tax credit, and it's a good, how do they have no income? And so one of the things we talk about with folks, and I'm sure you do too, is, well, if you pile up money in the bank right before you get to retirement, right, taking money out of the bank is not a taxable event. Right? So, and then I think this is really important to bring up too, that it's not, when we talk about tax planning, it's not, look at these 2 things and then do your plan, right? It's not, what are your estimated payments? That's part of it.
Right.
But there's all these things that come in, and we're talking about doing what we're doing here is, does it make sense to have no income to get that premium tax credit?
Right.
Or are you better off by taking money that's in your retirement plans and turning it into a Roth IRA perhaps?
Right.
Or selling some stocks that have gone up and paying 0% capital gains taxes. But when you do those things, then you got to be careful of the Medicare limits.
Right.
And then you got to be careful, and then that ties in with, and it's this multi-step process. It's not different than, maxing out your 401k. There's some complexity, but golly, it's really, there's 3 steps and we can do it.
Yeah.
This is a thing where you can't just take a look. I mean, you have to actually run the numbers and look at how these things all interact. And it's complicated, right? And it's worth paying for advice. I guess maybe that's one of my points here is, you think, well, geez, I just paid a big tax bill, had my taxes done, 2 months ago, and I don't have to think about it. This is an investment in some advice now that really can pay off in the future, and I mean, hundreds or thousands of dollars by being proactive on things.
Right.
Yeah.
In my experience I had a tax practice, and this was years ago, and I had a lot of frustration because I felt like I wasn't, even though I'd ask clients to come in for planning meetings, they didn't want to pay for it because I was charging hourly, which is understandable. So then when I switched over to financial planning and using a retainer model, it was included, and then people are like, oh, this is included, I guess I better do it. Mm-hmm. And so that is one of the things that I love about actually my business now, is that we actually do tax planning so that we can get in on the action. That's where the action is with taxes. It's in planning. It's not in execution. And
most of the tax preparers are built to report what happened, which is not, I mean, you need to do this stuff, right? But that bang for the buck, I'll share just one other quick story, is we had, maybe 2 stories if we have time. We have a client, and they were run a medical practice, and they bought a bunch of equipment one year. and they had a business tax person, they had a business CPA, a personal tax person, and I said, well, how are you going to handle those deducting that? And he said, well, what do you mean? Well, you have two choices. You can spread it out, or you can take it in 1 year. And he said, well, and I remember the wife, geez, why didn't Jim, our tax person, tell us this? I said, well, the business guy wasn't talking to the personal guy, and neither one of them was talking to the investment folks when we came in. And I said, well, geez, it might make sense. Ask your folks and see if you deduct it all in 1 year, maybe your income goes down to zero. And then you can take some money in your IRAs and turn it into Roth IRAs, and money you deducted at 25 or 35%, and for 0% or 10% turn into tax-free money in the future, and save like $25,000 in taxes by making this transition. So we're able to do that, and it's not that the tax folks were bad or not doing their job. It's just that's not what they're designed to do. And we had another person came to us after a year that they had a big investment in real estate and it lost money, and it was, I think, a six-figure loss if I remember right. And so they had negative income, right? They had zero income. They didn't have to worry about tax planning, except for had they taken some of their retirement plan money, they could have turned it, if they had a $100,000 loss, we could take $100,000 and make it tax-free for the rest of their lives. Right. But again, the CPAs aren't wired to do that proactive thinking. And so that's why, maybe to circle back on things, the biggest mistake people make is not planning today for this year. Next spring is just reporting. This is the time where you can really make a difference in your tax situation.
So when people want to do tax planning, where is the best place to get it? I think a good place to start actually is your CPA. Because calling them now, they will be so happy to hear from you this time of year. If you're saying, hey, can we set up a meeting just to do some tax planning? I want to take a look at what happened last year and make sure I'm planning for next year. So, but some people aren't necessarily designed to do that. What are your other suggestions?
Well, it's a completely unbiased opinion is that you should go to the Alliance of Comprehensive Planners. Bridget and I are both members of ACP. We're fee-only, tax-focused financial advisors, and that's, there are people that do what we do out there that, the CPAs, I absolutely agree. Listen, those are the folks that are in the weeds with it. Ask them. Ask your financial advisor for help on this, and if your person doesn't give tax advice, ACP is a great place to go, but find somebody who's can bridge that gap, and there are people out there like us that do that.
Great place to wrap up. So I'm Bridget Sullivan-Mermel. I've got a fee-only financial planning practice in Chicago.
And I'm John Shear. I've got a fee-only financial planning practice in Middleton, Wisconsin. And before we go, remember to hit that subscribe button to help other people find this information. And if you like what we talk about on our show, please do visit acplanners.org to find an Alliance of Comprehensive Planners advisor in your area. Thanks. Until next time.